All right. Good afternoon, everybody. Welcome back to proposal review session number 2. Thanks to everybody for their good comments last week. Rasan, thanks for sharing some thoughts in writing as well. Today we are talking about a number of taxes related to business taxes, a number of proposals related to business taxes. We've got a few more fines and fees related proposals, a couple miscellaneous proposals, just 12 on the docket for today, but there's some meaty ones. So I look forward to a robust conversation. Again, I'm going to try to make time for a break, about an hour and a quarter into it. So around 3:15, hopefully we'll have time for a 10 to 15 minutes. Just a little bit of a preview of the future. Next week, we're meeting on the 26th. We're back to a Tuesday evening slot. We have a few more business tax proposals, and then we're getting into property taxes. We've got a whole bunch of property tax proposals, big and small, lined up for you all to be thinking about. On October 3rd, we will set aside proposal review for a week and have a session talking about economic competitiveness. We'll be here from some folks from Texas and from Tennessee about drivers of municipal economic growth in those places. And then back at it the following 2 weeks after that with a number of income tax proposals. October is income tax month, as well as whatever we haven't gotten to by the end of September. A couple of process notes, as you all know. Once we get through all of this, all the proposals, and get your input and feedback on them, we'll be putting together a chairman's mark for you all to consider. Our goal is to have that by November for you all to discuss. And then, and so I'll be sending around some dates very soon for you to hold for possible, just to make sure that those are on your calendar for November, December. We have gotten some questions about, hey, are you guys still taking public comment? And the answer is absolutely. In fact, arguably, it's even more helpful now to hear people reacting to specific proposals that have been put on the table, specific content, as well as reacting to the conversations that people are listening to online and streaming. So we are taking those written via the website. We've rejiggered the website a little bit to make it particularly helpful to people who want to comment on a specific proposal. We're also working on scheduling a town hall for people who want to come speak in person on that. I think we're looking at early November for that. So we'll send around a note as soon as that's set, but maybe November 6th possibly is the goal. I think that's all the process notes I have before diving in. Anything anyone else to ask?
Just quickly, Nick, when do you anticipate bringing proposals to us that fulfill some of the other council conditions? Making our policies more competitive with the surrounding jurisdiction and encouraging job growth, business growth and job creation.
Yeah, over the next couple of sessions. We've got a number of business tax proposals today. We've got several next time as well.
So we could expect them for the next 2 weeks, or is this also in October?
So I didn't organize these by policy purpose. We've organized them by type of tax. So there are some, I think there are some when we're talking about income taxes in October, I think there are some that you're going to find meet that criteria, and also some in the business and property tax proposals that you're seeing today and next week as well.
Just, for what it's worth, if we could have them somewhat in the buckets that the council asked for them, that would help in the evaluation. So personally, I don't know how the others feel, but the council gave us specific instructions. Their findings were very clear. Their findings were that the tax burden is heavy on district residents. They're looking for reductions in some areas where the burden is heavy. And they're looking for specific proposals, specific recommendations. I think there are 5 areas: broadening the tax base, you know this well, competitiveness, job growth, transparency. It would help me if I knew that we were thinking in terms of buckets, so we could then compare them with the charge given to us. That's all.
Yeah, David, I'll take the hit on this. We did this in 2013, and I strongly recommend to Nick to do it by tax type, because a lot of these proposals are confusing. And to be blunt and selfish, it helps me as the person proposing it to discuss them within the same type of tax. Because we can then have conversations that build on each other. But we've tried to put like commission goal at the top and be very clear, and I think when they come, we'll be very explicit about this is what the goal is for and why you would want to consider it.
It's just, again, I appreciate, however the staff feels it needs to organize it, but at the end of the day, we need to be responding to the recommendations that were given to us, or the charges that were given to us. And not take kind of our own detour here.
Okay. All right, well, other questions, comments? Well, we're gonna dive in. I'm gonna start with, I would love for Tony to be here for the full discussion of the business activity taxes. I think that's the big one on the table today, and I want to make sure we have a full discussion of that. I'm gonna start with B3, simplify and update the business franchise tax. So the business franchise tax refers to both the corporate franchise tax, which is paid by C corporations and S corporations to tax on their profits. It's pretty similar to the federal corporate income tax in terms of its tax base, 8.25% tax. And it also refers to the unincorporated business tax, which is very similar, but unlike the federal corporate income tax, is applied to particular unincorporated businesses, largely paid by sole proprietorships in the district. Many partnerships are not subject to the business franchise tax, nor are nonprofits, because it's a tax on profits, and nonprofits obviously don't have profits. So this proposal really gets at the fact that a number of parameters of the tax have really not been adjusted in many years or decades, and or complex, or have outlived their usefulness, arguably. And we heard in our public hearings from folks about some of these complexities. So, and this is really, if there's obviously a broader question about whether we're keeping in the long term the business franchise tax, but assuming that we keep it in some way, shape, or form, we've identified a few specific proposals to make it a little bit simpler, less burdensome, especially on smaller taxpayers, and a little more consistent and clearer. So the first change would be to increase the filing threshold, which is currently $12,000 in gross income. So it would be to increase that to $50,000. And then it would also be to increase the minimum tax that corporations pay. If they have income above that level, they pay they pay the 8.25% rate, but if for any reason they don't have tax liability, they would pay a minimum tax of $350 if their gross income is below $1.5 million, or a minimum tax of $1,500 if it's above $1.5 million. So those are increases over the current $250 and.
Do you know how many filers, what percentage of filers don't pay enough to meet the threshold, or have to pay the minimum tax as opposed to just whatever they owe?
Yeah, I don't know.
I mean, is it a lot or a little, or few, many?
It's a significant number because these changes do have fiscal impact, but the big dollars are the folks who are paying actual tax on the profits. So we are talking about a small impact on a fairly large number of businesses.
And what is the reason you would not be paying tax and have to pay this minimum because you have not had the profit that year?
Right, exactly. If you don't have taxable profit, but it could be that you're doing quite well and you've chosen not to take profit. So it's a way of assuring that a corporation is paying a certain amount of tax.
Can I ask, what are the competitive, our surrounding jurisdictions, what did they charge for the franchise tax equivalent?
My tax tax.
So Maryland and Virginia, just.
I have that.
Yeah, we can get that for you. So the arguments for.
I should know this, but I don't. But in general, when we have thresholds like this in the DC tax code, are they generally indexed for inflation or generally not?
It's a mix. In the income tax, a lot of they're not, next month we'll be talking about proposal to index the thresholds. A lot of the places where we piggyback, like the federal standard deduction for the income tax is indexed. We follow the federal standard deduction, so that's indexed. There's a lot of other provisions that are indexed, but
Is there any rhyme or reason, or is it just the way it just?
I haven't been able to tell a rhyme or reason. I mean, I think an argument for doing it, obviously, is you maintain some sort of a consistency of policy over the years. An argument against adjusting for inflation is that you can then make intentional decisions about when you adjust these parameters rather than just having it sort of happen automatically and cost you revenue year in, year out. Maryland and Virginia, what is it?
Derek, can you say what it is?
Oh,
It's,
I'll let you do the honors.
it's 825 for DC, 825 for Montgomery County and Prince George's County, and all the counties in Fairfax, in Virginia, 6%.
That's the corporate tax rate. Right, but
Corporate tax
I think David was asking about the minimum.
The minimum tax.
I don't know, but
The minimum tax. We'll get that.
That would be, I think, helpful in the larger context of regional competitiveness.
I agree. Thanks for flagging that.
can you also remind me, I know I should know this, corporations pay corporate franchise taxes.
Right,
Partnerships don't pay anything.
right.
Who pays the unincorporated business taxes? Which
So
is why
it's-
are you laughing? Because it's a hard question.
It's a hard question to answer, and the data is actually not that great on it. The impression I have is that it is a lot of small proprietors, it is small property owners, if you own a small shopping center, for instance. Right, it's not anyone who's incorporated as a C corporation, it's not anyone who's an S corporation, it's not professional partnerships. It was professional partnerships, but the courts in the Bishop decision ruled that violated the Home Rule Act.
And it catches things like hedge funds and REITs and stuff like that, right? Because I
Some.
remember some
I
of
mean,
my
REITs are
companies-
corporations, so they are
REITs are
taxed. I think it generally does not capture financial firms. A lot of those are going to be partnerships.
And we have that largely to capture commuters, because not many jurisdictions have unincorporated business taxes. So can you
Right.
remind me
Yeah,
again
I
why
think
we
that-
have it in the first place?
And that goes to David, a little bit goes to David's competitiveness question. So, right, other jurisdictions do not have an unincorporated business tax law. And we have a proposal we're not putting in front of you today, but we will put in front of you probably next week about repealing the unincorporated business tax law. I'll get to that more length, but other jurisdictions don't have an unincorporated business tax, but other jurisdictions are able to tax the incomes of out-of-state residents. So North Carolina, if a DC resident owns income-producing property in North Carolina, even though they're a non-resident, North Carolina can tax that income can tax the DC resident as a non-resident. We can't tax non-residents, so we are instead taxing the entity in DC. So it's a little bit analogous to other states' taxes on non-residents.
So if I'm a DC resident who owns 3 properties and rents them out and makes an annual profit of $100,000 from these properties, I'm paying 8.25 on that 100 through the unincorporated business taxes. But if that was taxed as income, that would be about 6%.
Right, and we will get to that in
Okay.
this when we talk about more directly about the unincorporated business tax. But right, and you would pay, and just to be clear, if you're a DC resident and you pay unincorporated business tax, you can deduct that from your DC income tax.
Except if you're,
You can deduct the income that you're paying that on from your DC income tax.
say it again.
You don't pay DC individual income tax on the income that you earn as an unincorporated business.
Except if your income is low enough that you would rather have paid the individual income taxes.
Right.
So I didn't find comparisons of the corporate minimums, but our DC state tax comparisons with Virginia, Maryland report says that 60% of corporate franchise taxpayers and 57% of unincorporated business taxpayers paid the minimum tax. in
It's a big
2019.
number.
That's a lot.
What are those percentages?
So 60% of corporate franchise taxpayers and 57% of unincorporated business taxpayers paid the minimum tax in 2019.
But to get to what you alluded to, how much of that is from a legitimate lack of profit, if you will, versus, I'll use the word contrivance to avoid, whatever, just putting things in one year or the other, it's hard to know.
It's hard to know. Yeah, it's essentially really hard to know. I mean, and we'll talk about other proposals we have here that are more aimed at larger corporations that don't, that may be essentially not showing up with their profits.
Right.
Do you all know the last time we raised the corporate minimum?
Yeah, it was,
Is that in the, sorry, that was in here.
it seems to go back to 2011.
Okay.
The minimum taxes were set in 2011, the threshold was set in 1977, and these provisions in the UB tax that exempt the first $5,000 of income plus 30% of 30% set aside for owner's salary. I couldn't find where they go back to, at least 1960s.
But just know what our surrounding jurisdictions do as well. I think all of this is helpful, brain food, as we contemplate what decisions we make.
All right, let's move on. I'm going to jump now to FF. Go
Sorry,
ahead.
did we have a discussion on, sorry, I missed kind of.
Where we landing?
Yeah.
I didn't hear a lot of strong
Questions, we can
opinions.
give opinions.
I didn't hear a lot of strong opinions. I would love to hear, yeah.
I differentiate between raising taxes, which I think we should not be doing in this economy at all, and updating and making things more fair. And so this general theory is, I'm supportive of it. I did draw a distinction between how we compare with our tax rate in the suburbs versus the threshold and a minimum. And I think there has to be some modicum of keeping up with inflation. I like the fact that as this is presented would provide relief to small businesses, which I assume would help with racial equity as well, and larger businesses. And I mean, a tax is a tax, but again, this is an anachronism of a rate that hasn't been adjusted over time, and it's a minimum, so it's a threshold. So I'm kind of sympathetic to it. It depends on what other relief we can provide businesses at the end, so I think we really won't know till we get through all these other things, but conceptually, I think I'm comfortable with it.
So I think where I might struggle, the updating part intuitively seems like it makes sense to me. Like it hasn't been adjusted since '77, this came from whatever year. So there's some attraction to that. I think with some of these, I have the same type of question where I might struggle is that, I'll say it this way, what might be helpful is for a certain business size and type to understand what the tax sort of burdens are today. So like if I can think about the business activity tax, then I can very quickly get sort of wrapped around, well, who exactly is paying what and how much and how many taxes apply. And I don't really know where I land on the issue until I can better understand what all of those are. And I don't know if you can do it for every type of thing that we tax, but if there's a small business representation, a medium size, a large, what applies here and how does it work? Because after you do you can deduct this and add that and switch that, like I have no idea who's actually paying what and what the burden feels like.
So we have a couple of great resources on that I can share with you. One is a 2020 study that ORA did on business taxes, where they look at a couple of different size businesses and model out, and not enough, and they do it for both DC and our surrounding jurisdictions. And some little things have changed, but not enough to really change.
That would be helpful.
There's also a good study from 2013, actually, that is largely still applicable. And then there's a tax foundation, KPMG study, 50 state study, including DC. So between those three, I think they're pretty good resources. So I'll write you guys a short memo.
Which unfortunately has us at 48.
No, that one doesn't. That one has us in a number of different places.
Tax Foundation?
Tax Foundation has a lot of different rankings. This is one that they did together with KPMG, where they do sort of model firms. And we'll have someone with the Tax Foundation on October 3rd, so we can say more about the different rankings that they do. But this one looks at different firm sizes and types and looks at what their liability is in different places.
Nick, can I ask you a question? So looking at the scoring of this proposal, it basically says, some people will pay $36 million more, some others will pay $10 million less. And on net, the impact of this proposal is $26 million. How did we choose these specific numbers that added up to a $26 million of positive revenue? Like, what is the motivation? Is this like a special number that's really great, or?
No,
this is what I mean.
we were not targeting a particular
It's your favorite
revenue. Yeah, 26
He
million.
likes 26.
I don't mean to sound glib at all, but you see my
No,
point, right?
There's another proposal we had at 26 million too, and maybe I'm subconsciously picking it. No, I tried to do some back of the envelope inflation adjustments, and
It's scalable.
it's scalable, and I think the feedback that you have given already and other feedback welcome helps us think about how might we adjust this. I can do a certain amount of back, I just haven't had a chance to do enough back and forth with it already to get to it.
But the basic proposal here is increase the threshold, so shift the burdens to larger grossing companies that are more likely to be deferring, at least the working theory is that they're more likely to be deferring profits.
And part of the theory here also is get around allow a number of smaller businesses not to have to file at all. It's really confusing, if you're a tiny little shop, we've identified a number of places, and we'll talk about some of them
They
later.
would still have to file because they still have to pay the minimum, or they won't have to.
Up to the filing threshold, no, that's the, so
If they're below
businesses up to
$50,000.
$50,000 would actually not have to file, they could just sort of submit an affidavit, and for clean hands purposes, they would just say, I don't know.
Glenn, what does that mean from a tax administration perspective?
I'm sorry.
Like letting smaller grossing businesses not to file corporate tax income or unincorporated business filings at all?
Depends on what kind of minimum requirements we'd have for filing. Usually tax administrators want you to still file something even though you don't qualify for any taxes or have any responsibility. What you're not doing is necessarily doing a lot of intensive auditing with firms that have been pushed to the margins of the tax, but I would tend to want to continue to collect their returns so they're still in the system. And that, because once you learn, studies have shown once you lose firms or taxpayers, they fall out of the system, they don't report to you, your base begins to shrink and it's hard to pull folks back in if policymakers want to implement another tax on that. And so that's my thoughts on it.
Thank you.
Other thoughts on business franchise tax simplification? All right, so we are jumping now into, I'm gonna jump ahead to fees and fines number 1 around business license fees. We had a good discussion last time about fees and fines generally and whether they belong in our jurisdiction, and I think there were different perspectives on that. Today we're talking specifically about business license fees, and these I think.
Is this FF1?
FF1, yeah. More than, these would clearly, most economists, as well public finance experts, tend to put business license fees into the category of taxes. DC right now has a system that we levy a huge array of confusing taxes on businesses. I think 120 different business types. Can cost hundreds, thousands of dollars a year, and it's a little random sort of which businesses are paying which. Altogether, it's not an insignificant revenue source, $112 million a year, It's administered by DLCA, it's a flat fee, but nonetheless, it's still a tax. This is not novel research by me. The council did a lot of work to consider this, a lot of testimony, and put together a piece of legislation which passed but was not funded. And it would largely eliminate the current system of additional fees for specific kinds of business, just be like $99 for a 2 years license, $49 for 6 months, some particular provisions for much smaller businesses as well. Why you would want to do this: simplifies, reduces barriers to doing business. It does have an exemption for businesses with gross receipts under $10,000. I think the arguments against doing it are whether this goes far enough. The bill that was passed maintained the basic structure of a flat fee rather than moving to something that's more proportional to receipts. And it kept it within DLCA rather than integrating it with other business tax systems. Not that OTR is necessarily looking for more taxes to administer, but it is interesting.
Can I ask a quick question? Is there
Yep.
a value to having the threshold be the same for the tax exemption and the licensure?
I would argue, yeah.
For simplicity's sake, all businesses split the difference, let's say $25,000 or less, or whatever the number is, no tax and no licensing fee.
Yeah, I basically have reproduced what went through the council and how they chose their $10,000 gross receipts fee. My guess is it was relatively stick a pin in it. I think it would be worth, when we put together a final package, if we want to do both of these things, to make them have a consistent rule. I would
Yeah, your minimum franchise tax is essentially your license fee. The cost of being in DC, right?
Right, and sort of doing the same thing for us.
But just to be clear, is the revenue impact the cost of implementation, or is the revenue impact also the reduction in some of the levels?
It was confusing.
It's both. So this is the full fiscal impact. This is the full fiscal impact from RA. So it includes some administrative costs, but also includes the net loss of revenue.
So if I,
So this is already law. So I guess my question is,
It's law, but it's not been
okay,
funded.
but it's law. It just hasn't been funded. So we are recommending, in theory, then all we need to do is recommend the money to fund it.
We could do that, or we could, as David sort of hinted at, we could say fund it, but change it in these certain ways to make it more consistent with broadly what we're doing.
Okay.
But this proposal is to simply to fund it.
And that costs how much?
That's this 8.6 million in the first year.
All right, but again, is that
after that.
net of the reduction in fees, or is that just the cost to implement?
Both.
All right, so the cost, so
Overall
again,
fiscal impact.
Okay, but-
Whatever that be.
Is it more in the first year because of implementation? Is that-
but again, we're,
1.6.
technically, we're only recommending additional expenditure to implement it.
Gregory, it's possible that, if I might, it's
Right.
possible that the fee increase associated with adjusting the minimum tax. All right, so if you adjust the minimum tax up, even though you might take it to $50,000, you might increase the amount of that tax. So it's possible there could be a positive fiscal impact from increasing through, inflation or whatever, the amount we're collecting there. That might offset, you see, the cost of implementing this to remove the fees for companies below that. So we could play, with the help of our CFO, we could come up with what those numbers might be to offset each other, equate it, and create a simpler system.
like the 26 million that we saw in the other, take it down carefully.
Like, it's why didn't the council fund it?
It wasn't a priority.
And how much did it cost to fund? Yeah, I keep on coming back to that.
8.6 million in the first year and 7 million after that.
When did this pass?
1.6 of that for implementation.
Okay, that's my-
7
that's
million
my-
as the cost of the.
That's what I'm going, yeah.
That's it.
I think with this, there's another maybe trivial, small thing. There's also an additional 10% charge on every business license for technology fee, and it's supposed to go create systems that actually improve the licensing, which has never really happened. So I don't know if it's something that we should be looking at. Do you remember this?
Say that again?
The 10% technology fee that's supposed to support licensing process,
Yes,
capital improvements or whatnot.
I remember that, yes. What were you asking about it? Are you suggesting we do that?
There is another element. If you reduce the license fees to zero, then your technical assistance or whatever fee goes to zero as well.
It's interesting.
Oh, the technology fee goes
Yeah.
to zero.
Yeah, we can figure out.
Yeah, it just
we can
something
figure
to
out
keep
how
in
that-
mind.
I mean,
Okay.
we should figure out how that fits, because I'm not clear on whether this all takes into account that 10% fee. It must.
Yeah, but that fee was to pay for technology for many of the things, or all the technology things that the agency has to do, not just this license fee.
I'm not arguing for or against
But you're
eliminating that. I'm just saying
Consider in the
that
context of,
we built other things on this fee structure, so every time you change it or eliminate it, I can debate with you whether that fee is necessary or not. But that's not my intention to
I got
say,
it.
like, we build things up on these structures.
oh, it influences that, I see
Yeah,
what you're
yeah.
saying, yeah.
Other comments on business license fees?
Well, in the context of we might broaden the tax base in other ways that would involve businesses, I think this is a good way to offset that.
And to be fair, we could go further. I mean, these guys raise something like $112 million a year. We could cut deeper into that. We could lower
I
the
mean, I
fees.
think it'd be great if at the end of this, we have a narrative of several things where we can say, small businesses, entrepreneurs are faring well by virtue of several things that we've done cumulatively. I think that should be a theme that we keep this track of.
Yeah, I like this one.
Colin's nodding.
Yes.
All right. So now that we've warmed up with a couple of somewhat smaller board proposals, let's turn to B1, the business activity tax. So each of the last two tax revision commissions.
What was the first one you guys were talking about when I came in?
Oh, sorry. We were talking about, we started with B3, simplify and update the business franchise tax.
Okay.
I should have said welcome.
So, Mayor,
Each of the last two tax commissions has proposed a fairly significant broadening of the tax base, using very different mechanisms in order to fund reductions in other business taxes. The 2013 commission did that in the form of a per employee tax, and Richard's going to talk about that in a moment. In 1998, the commission proposed a broad-based value-added tax, they call it business activity tax, as a way to finance elimination of business license fees, in the unincorporated business tax and the corporate franchise tax, as well as the personal property tax. So it was a very sweeping change in business taxation that was proposed in 1998. It was not enacted. But this proposal picks up on that with a couple of little twists. The first thing it does is it does create this new tax. So in other words, it's a tax on the value added by any business doing business in the district. And value added is measured, can be measured by gross receipts minus what a business is purchasing from other businesses. There are other ways to calculate value added, and we can get into that if you want. But in the first instance, that's what we're putting forward. We are suggesting a threshold, such as $200,000. So you would have to be doing at least $200,000 worth of businesses to go to a small business point before you paid anything. And then we have calculated this as a set percentage rate of the amount by which your business activity, so your receipts minus what you're paying for inputs, multiplied by 0.5% or 1 percentage point. It's a very broad base, so your percentage rate can be quite low and still owe a fair amount of money. For multi-state corporations, they would pay to the district according to the same formula that we use for the corporate franchise tax, which is basically based on the amount of sales that they're making into the district. I've modeled it in the way that I asked ORA to model this in the way that it was presented to us, which is that businesses would pay, who paid this would get a credit against their business franchise tax. And so businesses that are already paying substantial business franchise tax would not pay more. Businesses that have little or no business franchise tax, for whatever reason, would, this could be additive to what they otherwise would pay. And it would be deductible as a federal income tax. The main reasons to do this is it creates a broader tax base. You are taxing a wide range of business entities relative to their economic activity in the district. It represents the fact that when a business is operating in the district, it's putting a burden on DC for its services that is provided. Depending on exactly how we structure it, the way it's modeled here, it could, a very significant amount of the revenue could come from businesses that are not now paying any taxes, specifically professional partnerships, who are neither subject to the corporate franchise tax nor to the unincorporated business tax. Economists think a value-added tax is a great thing. They think it's very economically efficient because it is a broad-based tax. It does not pyramid. In other words, unlike a sales tax on business-to-business inputs, it does not pile up as items work their way through the supply chain. It does. We can set it up to exempt small businesses, and it's really not. It's a different tax than a lot of places. Other places levy, but it is not completely unique. Many jurisdictions, states and cities, have some kind of alternative business tax. Texas has something called the margins tax. Ohio has something called the commercial activities tax. Washington State has a business and occupations tax. These are all variations of broad-based taxes that start their calculations with the broad-based definition of gross receipts. This is most similarly modeled on a New Hampshire tax, which has some appealing features because it does not, because unlike a gross receipts tax, it does not it does not pyramid. It doesn't have this feature that every time a good gets sold to another businesses as it goes through the chain of production, it doesn't get taxed again and again and again. Under arguments against change, it's a change. It's a pretty significant change. We don't know exactly how much revenue it would raise. This is our sort of the revenue numbers you see here are the first best attempts by ORA to estimate it, but there's a fairly substantial process that we'd have to go through of refining the parameters, figuring out exactly how this is going to work, coming up with legislative language, and then trying to estimate the impact. This is not something that you sort of snap your fingers and implement. I would say if the commission decides to go forward with something like this, it would be a first step in a fairly extended process of consultation with stakeholders, consultation with attorneys, drafting, and so on.
So can I ask a couple questions on this?
Just let me say one more second. We did not model this as applying to nonprofits, but it could. We modeled this as a $200,000 threshold. That number is relatively arbitrary and scalable depending on how we want to go. And just to explain the revenue numbers at the back, if you look at the bottom line of that table, what it shows you is that under this proposal, the corporate franchise tax players, if there was a 5% BAT business activity, corporate franchise tax players would only pay a little bit more than they are currently paying now. The big difference, same with UB taxpayers, the big difference would be the taxpayers who are currently neither subject to the corporate franchise tax or the UB who would pay a majority of the new tax.
Can I ask a question?
Go ahead, Josh.
Thank you, David. Let's say I'm a partner in a law firm who lives in DC, and I have a take-home salary of $1 million, over which we cannot right now levy corporate income taxes, right?
A partner in a firm who lives outside of DC?
No, in DC. So I'm going
Okay.
to walk us through both. So I just want to understand
Yeah.
where the impacts are coming from. So now I'm paying 11.5%, whatever, tax on my income taxes in DC. Under this model, a certain percentage of that will be taken away as business activity tax. But what am I taking credit against? Am I taking credit against the paid taxes or the income over which I paid taxes? Like, what happens to my income taxes? I guess my question.
This would be, it would reduce the tax would reduce your taxable income, so you would pay less tax on your income. That would be the main impact.
So we'll be shifting largely the burdens from DC residents of all sorts of stripes to those who are not paying taxes currently. They'll be paying a little bit more under this, right? And a non-DC resident will be actually, if I'm taking that $1 million partner income to Virginia, I'm going to be paying far more. I'll be paying, whatever, 4% in DC, 2%, whatever the number is, and then plus 6% in Virginia. So now my marginal tax rate on that income is 8%. Not even marginal, close to marginal.
Right, so this would be so let's say you're paying a half a percent business activity tax on the overall income of the firm. It's not necessarily on the total. So that would reduce, you would pay that tax, the partnership would be paying that tax to the district. It would reduce the income that's then distributed to the partner, and so they would presumably be paying a half of a percent, they would be getting a half of a percentage point less in income. Yeah.
So what happens if a business isn't making a profit?
Can I
It's a-
piggyback on her question though, first?
Oh, I'm sorry, I didn't realize you were in line.
No, but she was asking a question, I just wanted to jump on it before we lost her train of thought, that's all. So if I'm to come back to her example, so the partnership's income now has been reduced. I'm the DC partner, how is that being calculated then as against, see what I mean, that's a problem. It's not a deal breaker, but it's a problem, okay, go ahead. I mean, you don't have to answer it here, but go ahead, yeah.
So I don't like this proposal, nothing personal. I think it is kind of an existentialist crisis to business in the city. I think there's few things that have been presented that are as alarming to me as this. What happens if a business doesn't make any money? We are under the presumption, let me just be clear, we're under the presumption that all businesses make profits and that all businesses have the ability to pay this. I want to speak on behalf of a lot of businesses that don't make money, that have very thin margins. And so if you are, particularly in underserved communities, if we are to be focused on this subject of racial equity, your least capitalized businesses are often in communities that are least capitalized. And so if you're going to go to the corner store and say you've got to pay 3%, whether you make any money or not, in fact, you could be losing money, and we're going to dig deep and you're going to pay more. That's a problem, number one. Number two, and just be very quickly, and we're a lot in technology space. If we want no startup community in the city, this is precisely the way to go. No company in their right mind is going to invest in a district startup if we're going to tax based on receipts, not profit. They're just not going to do it. It would be malpractice for them, a violation of duty of loyalty and duty of care to their boards to be located in the district. That, aside from making the accountants rich, I don't see the value to this.
So let me, just to clarify, not to take anything from what we just said, just a couple of points of clarification. When I say we're not taxing profits, I mean that in a sort of literal tax sense. So this is not a tax on business profits. If a business is literally, if as an owner of a business, you are literally not making any money from the business, then there is no tax. So unlike a gross receipts tax, a gross receipts tax is a tax on all the money that comes in the door. this is a tax on the money that comes in the door minus the money that you're paying out to, say, vendors, to other suppliers.
But how is a
So
small
if you're,
business, I'm sorry for interrupting, but how is a small business supposed to figure this out?
oh, it's actually simpler to, probably at least as simple to figure out as, say, the current unincorporated business tax. And some of the other taxes, as well as the
Well,
personal
what's the
property
difference
tax.
between this and the tax we have now on profits?
Say again?
So if we tax profits now, if this isn't
Right.
going to tax companies that don't make any money, right? We're not taxing the companies that are not making money or losing money. This is just another type of an income tax on businesses that you're attempting to apply more broadly.
Right, it is a tax on a broader one way to think about it is a tax on a broader definition of income. So usually when we think about a business income tax, we're talking about a tax on business profits, which is sort of profits after lots and lots of different expenses are deducted. This is a tax on income minus a much smaller range of business.
And, again, I just
So,
want to
no,
retain my concerns. Something isn't ringing true, but in any event,
Yeah.
the impact on creating a place where startups would want to come, this is troublesome.
So one way to think about this is, and I'm not trying to debate, there are other jurisdictions that have had more broad-based taxes. So for instance, the state of Washington has a business and occupations tax. It doesn't have a broad-based personal income tax, but it has a business and occupations tax, which is more of a, which is arguably a little more similar to this, or this would sort of be in between the two.
Two of the four states, right, that have a gross receipts tax have no personal income tax. So Washington and Texas have no personal income tax. They have a broad gross receipts tax. The other is Ohio and Nevada. As far as some kind of a blended rate, you're starting to get into Tennessee, Oregon, and Delaware. Again, Delaware has no income tax. I just don't think I know enough to endorse this, but what I know about it, I'm not inclined to support at all.
Nick, is there a way,
Anybody want to
I-
speak in favor of it? Just so we have a stereo going.
So I agree with David, I probably don't know enough about it, but what I do know I like. And David's example, I think, is very compelling, and I think hopefully there's a way to work around that in terms of small businesses and entrepreneurs. But to put it bluntly, for me, the attraction is, and I go back to the multi-million-dollar lawyers and consultants and lobbyists who live in the suburbs, and they don't pay. It's not fair. And because of any democratic congressional preemption, we can't tax them. And so it's not fair. And if we want to provide relief to other taxpayers through our work today, we have got to find some extra income along the way. And the best place to go is to address things that are blatantly unfair and undemocratic. And so maybe there's a way to fix it around the scenarios that David has, but the lobbyists and consultants and the like and lawyers here who come into the city and live in the suburbs and don't contribute anything, and may even be working from home now, that has to stop. And it'd be great to take the extra income from whatever that is and turn it back into DC businesses and DC residents. So I don't look at this as tax raising. I look at it, as you said, broadening the base and trying to correct, perhaps in an imperfect, blunt way, where we are with regards to not being able to tax income at a source.
Well, Gregory, what if, just curious, I'm sorry, I make more, yeah, sure. What if people work from home more?
Excuse me?
What if people start working from home more? What if the lobbyists or the people who own baseball stadiums just work from home and don't pay anything? They won't pay anything now, they won't pay anything under this.
Well, first of all, baseball people come to the ballpark, so that's not a problem. And that was really a very infelicitous example, thank you.
I want to say something though, Gregory,
Yeah.
because there is a possibility that people will choose to work from home.
Right.
These people who live in the suburbs will choose to work from home and be taxed where they live and not here.
Right.
And, just curiously, I don't think it's an unsolicited comment at all. I mean, business activity tax doesn't apply to baseball stadiums or baseball owners who live outside of the city.
Right.
They pay nothing to the city.
Well, the baseball team pays taxes to the city, thank you very much. But I think that.
And what are they?
Was that?
And what are they? Because I remember them being totally exempt, except for the sales tax that go
No,
to
it's a
support
business
the bonds.
located here in the
Okay,
district.
well, we'll talk about this
Yeah.
later, Gregory. I'm interested in this.
But I think that your example is just, okay, fine, they've got us under a barrel, they've been that way for 20 or 30 years, so the lawyer across the hall who happens to live in the city pays, and the lawyer across the hall who lives in Virginia doesn't. That's inherently unfair.
I'm not
So
saying.
the
it
lawyer
is.
in
I'm
Virginia
saying
who's
two
probably
wrongs.
working from home now is not buying a lunch anymore, or not buying office supplies downtown anyway, because he probably is working from home. And they're giving up their office spaces anyway. So it's just, I mean, sure, we're stuck in this position of this unfair, undemocratic thing, and now we can't change it because somebody may leave because they won't get a good deal anymore.
I'm just trying to
someone's
not
got to call the
compound our
question.
problems by making two wrongs into one. I'm just trying to be clear on that.
But I prefer to take that money and give it to DC residents.
I want a slightly different scoring of this. I think what I don't like about this proposal is it's actually adding yet another tax. So there's this proposal of simplifying and updating franchise taxes. There's the proposal of getting rid of the license fees. Can we score it so that we get rid of franchise taxes, we get rid of unincorporated business taxes, we get rid of business license fees? So the only thing people pay is the entity tax. So we're gonna try to find a way to raise $1.1 billion. I think first, is there an argument against having such a high gross receipts type tax? Is it something we should worry about? I think I'd be interested to see that research. What are the typical rates in other places? What does it mean from a tax administration perspective? Like, we're not going to be piggybacking on the feds anymore.
Right.
But I would really like to see some numbers around that. Thank you.
Is the intent of this, if you pay franchise tax today, for example, or unincorporated business tax today, that you would not pay this, whatever your liability is for this activity tax is you get credit for those other taxes that you pay?
That's under New Hampshire.
So if I pay corporate franchise tax, then I wouldn't have a liability or a very small liability under this tax. Is that the idea?
That's the idea.
And so this is then targeted for people who either don't pay corporate, don't pay unincorporated business, and then pay this.
Right.
And you think, we think those people are people who don't live here but have business here? Or is that not necessarily the case?
It's neutral on where the owners live. It's where the entity is. So this is entities.
It's entity specific.
It's an entity business.
And then this goes, I'm not fixed on this quite yet, but part of this also for me is to the first question is what amount of tax are we talking relative to what other taxpayers are paying for businesses of similar volume is an important, I think, understanding point for me at least.
So, yeah, and so we can share that. I mean, if you think about it generally, if we use the revenue we raise from this change to pay for other reductions, say in business taxes, then on average, businesses are going to be held harmless. Some will pay more, some will pay less, and the question is is there a fairer regime to move to? I just want to come back to your point, Isham, about modeling, which is we can do that. The model's going to be uncertain. And so one option would be to do a kind of a phase-in approach where you start at a low rate, you keep some or all of the other taxes. You start at a low rate, you see how much revenue you're raising, and then you can scale up and phase out the other taxes.
Yeah, we had that problem with the gross receipts tax. It brought far more than into the baseball fund.
So Nick, I just want to go back
That
to
makes sense.
that other point, just to kind of amplify how I'm thinking about this and convey how I'm thinking about this. If I'm a business that generates $1 million in income, and this tax frame, I was gonna say scheme, this tax frame, I didn't mean scheme though. This tax frame results in a liability of me paying $10,000 in taxes or $30,000 or $100,000 in taxes. Like I have no idea how to think about the amount relative to income earned. Like, because I see this big number in the aggregate. Corporate franchise tax payers pay $500 million. I don't know what that means for a business and a payer.
good point, right? So we can provide you some examples. I guess I would just say, think about a business, if you're taking in $1 million, a business that's taking in $1 million in receipts, and is spending $250,000 on purchases from outside of the business, what's left is $750,000. So this would be 1/2 of 1% or 1% of $750,000. So it might be $7,000, $7,500.
I'm sorry, I'm confused. The business takes in $1 million, it has $1 million in expenses. All right, because of purchases and employees and rent, insurance and all this. They have $1 million in expenses, they take $1 million. How much do they pay in taxes?
It depends what those expenses are. So it's the purchases.
That's where you lose me, because this seems like a 3-card Monte. Okay? Because I look at profit as, this is something everyone understands. Look, this city is under siege financially. So before we throw a baby out with the bathwater and usher in a whole system that's going to make accounts rich and upset a lot of other apple carts, we need to know, how does it compare with the current system? If I have a business that makes $1 million in ways that I understand those costs to be, my employees, my rent, my insurance, et cetera, if those things are $1 million, my business expenses, then I don't make any money. Therefore, I would pay what?
May I try to answer your question? So here's how I'm thinking about this proposal. Right now, compared to now, if we adopt something like this, there will be 2 types of burden shifting. The first type of burden shifting is from DC taxpayers to people who work in a company partnership in DC but live elsewhere. So that's number one. The second type of burden shifting, which I think you guys are asking about, is right now, companies that are very personnel heavy, so they're paying a lot of salaries, will be actually paying more under this tax. Companies that are ingredient heavy, so they're buying a lot of other stuff from other companies, they will be paying less. You can expect some adjustments, maybe rather than hiring full-time people, I'm gonna go to, my friends here and say, okay, let's write a contract, we'll take this human salaries and turn them into contracts and expenditures. But generally, so you're gonna see a lot of shifts to companies that are wage heavy in their spending, pay more.
So we'll tax the people who employ more.
That's right.
Because that's not a deductible expense?
Yes,
Is that why?
it's not deductible. Like a pure gross receipts, nothing is deductible. In this value added, you can take out your investments in stuff you buy. If you're a printer, if you're a printer, let's say, you can take out the paper, the ink, the machine, the bolts and whatnot, but you cannot take out the guy who's typesetting the book.
Why, what's the rationale behind that?
So the rationale is that the company that's selling you the printer, the ink, and so on has already paid tax themselves. So what you're trying to avoid is what the economists call pyramiding, which is in a pure gross receipts taxes where the folks making the printer's tax,
You're retaxing.
and then you're retaxing.
Hence the value added tax,
So that's
because you're only taxing the value that this company adds. Of course, this is just an esoteric concept because we pyramid the other taxes all the time. So.
Has any state addressed this disparity between personnel, non-personnel?
Personnel not, well,
Who has this, in other words, you know what I'm saying? Has any state in our research, or do we need to look, how have states addressed this line that Yesham's talking about?
yeah, the Texas margins tax, which is widely disliked, but it raises a lot of revenue, and allowed them to replace their corporate income tax with a margins tax, allows you to either deduct a chunk of your salary expense or a chunk of your purchases. I think that's how it works. And it's, you can deduct whichever is the greater. It's a little random, but it was sort of what came out of the political process in Texas.
This doesn't prove to be a disincentive to companies locating that have big jobs. I'm gonna hire, you wanna attract APC firm and they're gonna hire 500 people. Now, might they not hire 500 people because we have this tax that they will, one, have to pay that didn't exist before, but two, are disfavored from other kinds of businesses that don't have such a heavy salary burden?
So I'll answer my way, which looks like you have, so you'll say too. I would argue that, look, it's a tax. Someone's gonna have to pay the tax in order to raise the revenue to reduce other forms of taxation. So the way to think about it would be to compare this tax to, say, a tax on profits. I think a lot of people are concerned that a tax on profits is a disincentive to the investors who are hoping to earn a lot of money based on their
Pick your poison, it sounds like
investment.
what you
So
just
there's a
said.
little bit of a pick your poison here to, element to it, yeah. Do you have anything on that?
I was just gonna add that unfortunately comparisons are challenging for the reasons Greg keeps bringing up, which is that the district is unique in that it's prevented from making some decisions about taxing non-residents. Whereas in other states, they might have this conversation, but at the end of the day, they have a choice between the income tax or a gross receipts tax, but those tools are on the table to make it like they want. Whereas in the district, you're kind of always having these conversations, one hand tied behind your back, which leads you to looking for ideas like this that might tackle one problem, but will also raise other ones, and you just have to keep working at it to try and find the best way to thread the needle.
Well, hearing the conversation, I think I'm totally against it. At first I was for it, but I think the point that you made about the salaries of those companies that have wages, salaried employees, like top heavy there, that would be problematic. Because I misunderstood your definition of gross receipts. So it's exclusive of salary, for the most part.
Right, it's a tax on, yeah.
I think there's another way to look at it. Like, so we are trying to understand how the burdens will shift. I think that there is also, going back to Nick's point, like right now, if you don't make any profits for multiple reasons, it could be for multiple reasons, right? You might be tax planning, you might have really good accountants and whatnot. You're not paying any income taxes, franchise taxes. This will eliminate that problem. Again, I just want to see like the alternatives.
Yeah, I think I would like to not dump this in the trash bin. I think we should model out a few different scenarios that were raised here and look into some of these questions. I think the fact that we get to broaden something like this would let us broaden our tax base to folks who are currently not paying in, and give us more of that stability and resilience alone is a reason to keep it on the table and to just look into like different ways we might
So here's a question for you in the,
implement.
because as Richard said, we have a contorted, weird tax system here. Everything is difficult. And even in the best case, when you're talking about taxes, you're always in the hard quadrant, right? Okay, so if you had to rank all the different proposals here, equity, efficiency, in this case, in terms of efficiency or broadening the base, would this be, if you ranked all the proposals in the books, would this be in your mind, I'm just saying in your mind, the best attempt at broadening the base in terms of value, not dollars? Or are there other options we're going to be looking at that broaden the base in this comprehensive way? You know what I'm asking? Okay, and the answer?
I think in terms of the business tax base, I think this is the best option. I think you could look at a more pure gross receipts tax that would not allow deductions for purchases from outside. Other businesses in other states have done that. What they end up doing is they end up setting different rates. Grocery stores have very small margins, so they pay at a lower rate and so on. So it's not the only option there. I think economically, this is probably the best option.
But in our list of 80, is this the biggest base broadener?
I think so.
I'm trying to think of a
Yeah, because I
bigger,
don't,
I mean, unless you go, some of the property tax, we talked about raising the sales tax by a penny. We talked about some of the property tax changes. So those are
Could
not-
some of the concerns that Carolyn raised, some of them I guess could, but could they be addressed by just messing with the threshold and raising it?
By threshold
maybe
and
to
some
give
of the
some-
definitions.
That's the David thing. I think at the end of the day, and this is just a crude way of looking at it, all of us in our mind have some tax relief that we want to come out of this process, be it for competitiveness or home ownership and affordability or racial equity or families or children or childcare. And that those wanna-haves are gonna pile up to a big amount of money. And we're not, if we don't broaden the base in some form or fashion, which nobody wants to do, I get that, we're not gonna be able to do that. And so here's something that has a significant amount of money that, and maybe it comes down with all these amendments that we're talking about, but I'm thinking of what we can do with this extra income in terms of other strategic relief. Because at the end of the day, if we're gonna have anything close to something that's budget neutral, we have to broaden the base. And so this is the only thing I think in the book that does it in a meaningful amount, that might accommodate some of the relief that all of us want to provide when those ideas come up in our subsequent meetings.
Except that we're going to wind up with the same problem we have in licensing fees, where we have separate fees for separate types of businesses, and no one's going to know which fee applies to them. And we don't know the unintended consequences, and we're doing it in the middle of the district on its back financially. And we are in the middle of a region where businesses, I think of businesses who work in all three jurisdictions. This is a whole new set of concerns, expectations, accounting costs, and exposure. And for what? No one likes to see people take advantage of the system. And we know that we have congressional limitations, but I don't think upsetting our entire economy just to get back at some lawyer who lives in Virginia is the answer. Cutting off our nose to spite our face is not worth it. And if the idea is broadening our tax base, then there's no reason, and I don't intend to support this, there's no reason nonprofits wouldn't be in it. None. Not one. If the notion is that you should all pay your fair share, then the same goes for nonprofits. Everybody has to pay some. And that's not what's on the table. It's, so when I hear people talk about other people paying, I'm struck by those who don't. And this doesn't address it. So if we really want a broad base, throw them in. If not, let's move on.
So that's a good segue. I want to suggest that we tackle one more before we take a break, because it's directly related, and then essentially, if this proposal I just described is the way the 1998 Commission tackled these questions, what Richard's going to describe is how the 2013 Commission.
Can I ask a question though before you do that?
Yes.
You might piggyback on David's point. Now, I don't know whether nonprofits around the country pay pilots. Has anyone done an inventory of where these pilots go? I know a lot of them go for fire and police. And
We'll talk about that next week.
Oh, you're gonna talk about that next week? Okay. Because a pilot could go toward relief in other taxes as part of broadening the base. It could.
It could. The pilots are contentious. And if you read news, so to pivot into the per employee service fee, this was recommended by the 2013 Tax Revision Commission. It was not adopted by the DC Council. Basically took everything, but we did recommend this. And the reason we recommended this is because we were having similar conversations to the one you're having today. In 2013, we talked endlessly about property tax exemptions. We talked endlessly about who doesn't pay and the restrictions on our ability to tax income. And we went down the list, and we talked a lot about pilots. But we decided that that was not the best route because the downsides were too negative. And it really is, you just get endless fights with nonprofits. You read news accounts in Providence, they go to war with Brown all the time. If you read about in Massachusetts, they go to war with those universities all the time because it's basically like a handshake deal. Like, it's a payment in lieu of tax. So it's basically saying, yeah, I think I'll pay. But of course, they say that someone's books don't add up one time, and they go and they fight it out. And we were really nervous about putting that forward and putting DC on the line for revenue that might not ever materialize. We also talked about a gross receipts tax. But someone in 2013 made the same point David just made, which is that you are possibly putting a very large burden on a low margin business, and that would be negative for the economy. So we said no to that. So we agreed to a per employee service fee, warts and all, because like all these taxes, they come with downside. The big benefit of this proposal is nonprofits would pay. Everyone would pay outside of the government.
On a per employee service.
On a per employee basis, you would pay either $50, $75, or $100 annually on the total number of employees you have. So the positive of this is broadening the tax base, and it's extremely simple. We don't talk about exemptions, carve-outs. You can do that. You can say, hey, if you only employ 5 people, you're not paying this tax. You can design this in all sorts of ways. But broadly speaking, it is a simple tax that everyone pays, and it achieves a lot of the goals to So the problems
Do it
we've
in
discussed.
Pittsburgh, right?
Pittsburgh did this, and that was where we got the idea, and that's why we put it forward. However, as some of you are probably anticipating, there's also downsides, which is it's literally a tax on employees. You know, you go from 101 employees to 110 employees, all of a sudden you're paying for those 10 more employees. As for the other notes on here on the racial equity, it's again, it's uncertain because again, it depends on how the business react. You know, it's like, yes, we have this really simple tax, it brings in more revenue, that helps the district. However, if those businesses start saying they're hiring fewer people, specifically fewer Black and Hispanic employees, it's not so good. Broadly speaking, we asked ORA to model 3 types of this, where it's again 50 per employee, 70 per employee, or 100 per employee for the entire year, which is, you know, relatively low. Pittsburgh had this, you know, but there aren't many other comparisons. But the goal of these numbers was like relatively low. You're looking at bringing in somewhere between $27 and $55 million annually. So this isn't, I think the BAT numbers were much higher, right? This is definitely, you know, this was simpler, you know, and that was the push behind it. But then there are still downsides, and one of the downsides is you would have to really jack up that number to bring in the kind of things we're looking for, you know, we viewed this as an add-on. This was not a big part of tax reform where we changed how the district is doing taxes. This was considered, let's address this one problem and move on. But that's a trade-off, because to keep it low enough that you hopefully wouldn't disrupt too much economic activity, you're still going to bring in relatively low amounts of revenue.
Who's paying this? Is it coming, like, I'm just reading through Pittsburgh and it says take it out of the paychecks, which makes me think that it's the employees who are paying it, right? But in DC, we cannot do it, hence the paid family leave. So we really don't have an example of this elsewhere.
Specifically, yeah, because we would again have to.
Thank you for the clarification.
So I'm happy to speak to this first. I certainly know there will be a robust discussion about nonprofits and what they pay or don't pay. And, you know, so 2 thoughts from a portion of the nonprofit community, which are universities. So a per employee tax for that population, for an institution like ours, where half the students are Pell Grant students, and we already have half the student population that can't afford to live in DC, a cost burden for some of those institutions just means less services to those students. And I think when we look at from a business attraction or an economic growth perspective, you can't discount the value and the economic activity that derive from some of these larger nonprofit institutions. For example, I hate to be parochial, but ours, that will contribute $1 billion in economic activity and contribute property tax contributions through private development activities for which we're bringing things on the tax rolls. And so I think we have to be really careful about what we want to say to those institutions that make contributions and significant ones financially to the economic base in lieu of what isn't a lot of net dollars, but could have a significant impact to what it is that we're trying to accomplish.
Nick, could I just follow up on that? Well, I'm completely sensitive to this. And you know, I make these jokes about nonprofits tongue-in-cheek just to point out what I think to be the double standard. With respect to the universities, you know, if we were looking to increase economic activity or district employment, I think it's worth exploring whether or not we would apply CBE requirements to universities in terms of employees that are district residents and or purchasing from the district's CBE, Department of Local Small and Disadvantaged Business. In other words, tethering the nonprofit tax-free status with the hiring of district residents, which would generate district income tax and opportunity, using the considerable resources and purchasing power of the universities, focusing them on purchasing in the district and off of the district supply schedule, creating a broader base for our local small disadvantaged businesses, which I think goes a long way towards improving the opportunities for Black and brown businesses, expanding, you know, home ownership opportunities for folks across the city. You know, why not think about how we're spending our money to currently to produce more activity instead of just adding more revenue? Would you be, I mean, what would your reaction be if we explored that?
Yeah, I mean, I think that's a worthwhile conversation. I can't speak for what all the universities do, but certainly our university already makes those commitments by policy without, I mean, we have goals that actually are in excess of CBE requirements for minority spending at our institution and for hiring, and certainly for deals that the city's involved, we're required to do that. But I think that's a perfectly good conversation and an appropriate conversation to have. And some are having it. Many universities are part of the Greater Washington Partnership conversation, which set the goal for specific investment in minority businesses and growth. And so that's a reasonable discussion.
And employees. And so part of a pilot could be, Mayor, and Brett Smiley, the mayor of Providence, is a friend of mine, a supporter. I know all about his goings on with Brown University off the record. So I'm aware that the struggle's there. If we were to have an idea of a pilot that tries to mirror some of the DBE requirements on a voluntary basis and a reporting, just to get people thinking about it, before we make people do stuff, let's enlist them. Let's show them what the LSDB office is. Let's start, looking at improving our own infrastructure, tax increases or tax revenue without tax increases. There, I said it.
So it's interesting because I think I have you say you talk about this to bring up a point about nonprofit. Yeah, I run a nonprofit, and I think if I was going to think really critically about this, I think it's fair to say nonprofits should pay their fair share. I mean, it may be an anathema for people to hear me say that, but I think
Is your board on the call?
I think there's a responsible way to do it. But let me take a step back. I think that because there's no context-free zone, I think the context that we're talking about today is one of pain. So we're going to feel some pain, right? We have to make painful decisions in order to get ahead. And so given the fact that that's the context, I feel like having a conversation about gross receipts minus cost of goods sold, and I would say a percentage of employees added to that. So there's a modification there. It's not, along with how do nonprofits at certain thresholds, I guess we got to figure out, we have to define a threshold for nonprofits to participate, or if it's not, or if it's just I'm sure there's going to be gradations for that. But I'm not the one to stand against there being parity when there's pain. It's the context that we're in. So, I'm sure I'm being recorded, but that's I may not be able to go to work tomorrow, but I feel like there needs to be that kind of conversation, so. Yeah.
Why don't we take a break like you suggested, and then we can come back. We've got a good conversation.
Sounds good. We'll come back at 3:35.
Sean, you buying my coffee?
Yeah, I owe you, yes. I owe you that.
Is there a coffee shop downstairs?
Anybody, does anybody want to chime in further about the per employee service fee? We most,
Just say, I'm sympathetic with trying to, reach people who don't currently pay, but also it's a competitiveness model. When businesses talk about impediments to moving into the city, this is just one more they're gonna put on the list. They're already paying a lot more money, they've got the, the family medical leave tax, and then this on top. I don't know, it just adds more rhetoric. Perhaps not a lot of money, it's just rhetorically, I can see people. Okay.
anyone else on the per employee service fee? Okay, we're gonna skip around a little bit. Let me jump ahead to B9, repeal the personal property tax, probably because Yashima was just talking about that, and Richard's gonna talk us through this one.
Okay, so this one, relatively simple, given some of the other stuff we're talking about. Currently, if you are a business, you pay property on your place, real property, but you also pay personal property, as long as the value of that personal property is in excess of $225,000. If your personal property, if your eligible personal property is above that threshold, you pay $3.40 per $100 of taxable value. Of course, like so many of other taxes, this is not true for all places. Nonprofits, wireless, some digital audio forms, qualified supermarkets, they're exempt from paying. However, notable, all businesses in the districts, even if they have no personal property tax liability or are exempt, must file what's known as FP 31, a 6-page document. Yes. About 60,000 property returns were filed from July 2022 to June 2023, but fewer than 1,500 of those filers actually had a tax liability. And so 91% of the revenue from personal property tax came from just 300 firms. This was a recommendation in the 1998 Tax Revision Commission. It is also a proposal that is popular among states, because the proposal is attractive to people who want to incentivize places to come here, because broadly speaking, this is a tax on businesses with stuff. But if you have stuff, you typically have employees, and so it's seen as a good competitive way to get your tax system more exciting for businesses by eliminating this. We have a range of proposals, one being just complete repeal of the tax, one being raising that exemption up to $325,000, so you'd have to have property worth that to pay the tax. But then also just on the administrative side, make it so that you don't have tax liability, you don't have to pay this, you have to file that paperwork every year, and just make this a whole heck of a lot simpler for everyone in the district. Again, arguments for change. There's the huge administrative burden, again, both for those who pay the tax and the many, many firms who do not pay the tax. It's actually a relatively complexity of tax that is also, has a bias in favor of those who have intangible assets because they're exempt, as opposed to those who have, again, stuff that are paying. And the competition thing, again, doing something that would be very pro-business, again, pro-location, pro-build. Against it, a big one is this is, for all its warts, it's a stable source of revenue. It brings in like $80 million a year, and if you were to get rid of it, you would have to go finding that revenue somewhere else. Districts' rates on personal property, again, for all the problems, are actually very competitive. It's lower than Virginia jurisdictions, although they are higher than rates in Montgomery County, Prince Georgia. Also, this would be a tax break for mostly affluent business holders, because again, very few firms pay it. They're the ones with a lot of income, a lot of wealth. And so to assist them, you would also be passing on the tax credit to them. As such, on racial equity, it gets exacerbated racial equity, because again, the people that would profit from it are typically higher income. However, on the administrative side, you would also be helping a lot of moderate income, minority-owned businesses that would no longer have to go through the nonsense of filing this, even though they've already been made, except for the tax a long time ago.
Let me ask, who are the 300 firms? I have no idea who they might be. Just curious.
It's a great question. I wish I knew the answer. Tax information is confidential. I have not been able to get a good snapshot of it. I mean, it's any business that owns, say, a lot of computer equipment, might have a business that owns a lot of, you know, I mean, it applies to office furniture, furnishings, that kind of stuff. But there must be some big businesses, and I just did, or a day that does not have it by, say, sector.
I support this increasing the exemption to a certain amount to accommodate the smaller businesses. I don't think we necessarily, unless I know who they are, if they've grown accustomed to paying it, if it's part of the understanding, that's fine. But for smaller businesses, I would totally favor getting rid of the requirement, and if they are paying taxes, eliminating it, for sure.
I also think, I would be against repealing it, but I would be for simplifying or sort of eliminating requirements that aren't needed. So, I mean, it might be worthwhile hearing if there's a reason for requiring businesses that don't have to pay the tax to still file.
Yeah, so I can't speak for OTR on this because this is a one-off tax as opposed to your bigger taxes, like sales tax, income tax, where you don't want to lose, who are on the margin and would fall off and have a zero liability because you increase an exemption or something like this. This tax is kind of one-off, so I can't answer that. Happy to, but I don't know if that makes sense. Yeah.
Is the 91%, is that what it is? Are those people paid 91% of 74 million?
Yep.
So, to put it crudely, is there a way to address the law through, I guess, the exemption to just include those 300? Like, is it just a matter of having the threshold at a certain place? Like,
Well, you don't want to create a cliff, is the thing. So you don't want someone to be like, if I buy $1 more of equipment, then I'm going to get a massive liability. So if you increase the threshold, you're giving a tax break to those three. If we increase the to
right.
everybody gets a break. But yeah, we can play with the threshold. We can push the threshold up higher. Yeah, I mean, this revenue loss from the $325,000 threshold is pretty high.
I mean, you know, I don't want to eliminate it either, but I go back to, you know, again, if you have a $250 million windfall, so to speak, of a business activity tax, there's some relief to provide as well for those, at least those 300. But yeah, I think we talk about just keeping a list of things we're doing to aid small businesses starting out, entrepreneurs, somehow finding a way that they don't have to file with a threshold as such that it doesn't apply. It's just another thing that even if we can't give them a big financial support, this is something.
And then adjust it for inflation, whatever the number you decide upon, it could be another area to have an adjusted amount.
I mean, the only thing I would say to push back on that is that this argument that you've included here about this is one way that we are able to tax businesses that aren't paying other taxes. I mean, maybe if we're doing the business activity tax, we're capturing those folks, that's one thing, but.
Right, that's a good point.
I think that I'm really puzzled by this tax because it says here it's a very stable source of revenue that's coming from 300 companies. I mean, I would have expected it to be much more volatile than that. I would love to see a world where smaller businesses won't be required to file, but I think if we adopt that within a couple of years, the revenue will be zero because there's no way. Like now at this point, you'll have to positively identify the company that's not filing and going and saying, oh, I see those Gucci drapes, like where's my money? I think we should find a way to eliminate this tax by adopting a much base broadening tax like the business activity tax. As you said, Gregory, then we're already shifting the burdens.
And therefore eliminate?
Yeah, get rid of it.
Okay. That's interesting.
So now you've taken 4 taxes plus, 3 taxes and plus business license fees, eliminated them all, and now only 1 tax pays for the same thing. So that's, to me, real simplification, right?
Mm-hmm.
Now we're gonna get down into the weeds a little bit, but this is base broadening, although at a much smaller scale. We'll talk about B6, and this sort of Joyce and Finnegan thing makes me think about, I don't know, a couple of Irish guys.
Yeah.
But Joyce and Finnegan, it's named after a couple of California court cases. The relevance of the specific facts of those cases kind of lost in the sands of time. I actually have not gone back and read the cases, but they refer to a couple of different standards of how we calculate corporate taxes. DC adopted combined reporting in 2011, and combined reporting essentially requires the corporations to pay taxes as an entity. If a corporation has subsidiaries around the country, they're required to pay taxes to the district as a single entity. But under the Joyce standard, which was the standard in place in 2011, it was what most states did back in 2011. It was what was thought to be most likely to be legal under federal law at that time. The Joyce standard allowed corporations to exclude from that group entities within the corporation that did not have taxable nexus in the district. The standard has changed now. Most states now use what's called the Finnegan method, which is a somewhat broader definition of who's in that corporate group paying taxes to the district. It's now, at the time the district enacted it, the Joyce method was what the Multi-State Tax Commission recommended. That's no longer the case. The MTC recommends either the Joyce or the Finnegan method. More and more states are moving this way, and it would raise, somewhat substantial amount of revenue, about $17 million a year, paid by multi-state corporations, specifically the part of multi-state corporations that are doing business outside the district, but making sales into the district. So it's a pretty, if you ask me too many technical questions about it, you'll exceed my understanding of how this works, but I do know it is very common now in the corporate tax world, and could bring in substantial revenue for us.
To move to Finnegan.
To move to the Finnegan standard.
I feel like this is basically an update to a policy we've already chosen to adopt. I sort of don't see why we wouldn't do it, particularly since so many other states have already done it. So there's not a risk of us sort of being out there like we might be with some of the other proposals we have.
Yeah, in fairness, I want to make sure I accurately capture the argument against it that the corporate tax community has put forward, which is that by broadening, every time you broaden the definition of combined reporting, you're pulling in parts of the corporation that are arguably somewhat outside of DC. So the corporate tax community has argued against this approach by arguing that it's the Joyce method that is the most accurate depiction of whether corporations are actually doing business in the district. Yeah, so I just want to make sure.
So let's say I'm a corporation that has $100 of tax liability, and under the Finnegan methods, Joyce method, current methods, I'm sending out of that $100 of tax liability I have in the entire world, I'm sending $3 to DC, okay? If we switch from Joyce to Finnegan, clearly that $3 will become $4 or $3.50, whatever. But is my overall worldwide tax liability changing? Or is it still staying at $100? In other words, it's just essentially taking more out of Virginia and putting into DC versus increasing the corporate tax liability in general?
I think the answer is it depends. I think a lot of times it will, because you are pulling in parts of the corporation you otherwise wouldn't tax, you're increasing their tax liability. But there are other states are capturing income that the district doesn't tax there's something called a throwback rule, where other states tax that if the district doesn't.
So we're essentially, okay, I see. I think then the answer is my liability is now over $100 because I'm paying income.
It may or may not. It may depend.
Okay.
On
Is there a world where this is just like literally just redistributing the same tax revenue?
Yeah, yes, for some companies, you are, California is capturing income that the district is not taxing, it's taxing it under what California calls the Field Act rule. So for some corporations.
So they'll send us more money, but South California beats it because we're just selling.
So, yeah.
I think Erica's comment was very astute, that the impact to certain people may be disadvantageous, but this is just a matter of updating an anachronism, and it's just, you just gotta do it because otherwise you're just perpetuating something that's an anomaly, and it's unfortunate that someone might be affected. Yeah.
Okay. All right, moving on, we're gonna now go from technical item to technical item. B8, Richard has volunteered to tackle the salt cap workaround.
Yes.
Which is
B8.
number B8, sorry.
Okay.
The salt cap workaround.
So we're really doing tax nerd stuff now. So bear with me, and I apologize if I get something wrong or if you something confusing. This is a mess. But basically, broadly speaking, if you were a business and you pay federal tax, you can either pay the federal corporate tax or you can pay the income tax, pass-through income thing. Okay. You used to be able to deduct all your state and local taxes no matter who you were. But then in 2017, they passed the Tax Cuts and Jobs Act, which created the SALT cap. A lot of people know about because it makes a lot of people mad because it meant their federal taxes went up because they weren't able to deduct all their state and local taxes. However, that only applies to you if you paid state and local income taxes. If you paid state and local business taxes, you can still deduct that fully, no cap. So what states have done is they've created what's called a pass-through entity tax. So you are currently a pass-through person, you're currently paying as an individual, but the state, to say it bluntly, basically gives you a piece of paper that says, no, you actually paid as a business. Don't worry about it. For the state, they don't lose anything because you set it up essentially so that it's the same amount of money as it would have been on the income system. Who it depends to and who it matters is the feds. Because the feds now go, oh, wait, you're a business? Oh, it's cool, don't worry, deduct all the taxes. As opposed to previously when you were stuck as an individual and they'd hit you with that cap. So we've now seen 30 plus states, red, blue, north, south, wherever, do this because broadly speaking, it's a way for them to make a paper change that doesn't affect their revenue because they're still bringing in the same, but helps their residents because then they can still now get around, it's called a workaround. They can work around that salt cap. So that's the argument for it, that this is that it's a benefit. And again, it's a kind of a revenue cost free, although you never know, and like there might be some needs to make sure it's all worked out. The arguments against it is very complex. Everything about this is complex, and we're adding a layer of complexity to our tax system. We're literally creating a new tax just to help someone do something on their federal taxes. And that also, Congress might change the law, because that SALT cap that's got everyone worked up is currently set to expire in tax year 2025. And so there is very much a world in which the district does this, says we're ready to go. We're like, what's the first year of 2026? And then Congress has completely changed what the federal relationship is with these taxes.
So you're saying the SALT expiration will be reinstated right now under 2017 law in 2026?
If Congress does not act,
Right.
the cap disappears, along with pretty much everything else.
Okay,
And
okay, go ahead, David.
I don't see the downside to this. If it's not costing the Treasury anything, our Treasury anything, it's costing the federal Treasury. Giving that district business owner who lives in the district an advantage over the business owner in the district who might live in Virginia or Maryland, I don't see why we wouldn't do this. Why this isn't a no-brainer.
Maryland and Virginia have done it.
Would this be complicated at all if there was a bat tax? Then suddenly, would the bat tax be deductible as well for these people?
Not particularly. I mean, it would be, a VAT would be a business
Right.
expense.
It wouldn't affect it at
So
all.
it would be deductible. Now, what could change, there's some technical stuff about how you would do this in a way that connects to the unincorporated business tax. So if you change the unincorporated business tax, you change a little bit, but that's in the design detail.
So Nick, there are tons of pastures in DC that don't pay any taxes right now. That has nothing to do with the salt cap. How did other jurisdictions handle this? Like create a new tax for pasture entities, but somehow prevent, like, not require these other pasture entities to pay this?
It's an optional tax,
It's an optional tax. Okay.
Sorry, yes.
which is a little bit of a contradiction in terms, an optional tax.
I love it.
By definition, taxes are usually mandatory. I think there's a little bit of legal work that needs to be done to make sure that an optional tax levy that pasture entities in the district are paying is not in violation of the Bishop decision, which bars us from collecting those kinds of taxes.
Can I just ask, what's the scenario here under which we might raise revenue?
It's it has to do with exactly how you design the credit. So essentially, for some taxpayers, if they got a little bit less of a credit than their firm was paying, on net, they would still benefit hugely because they would get a huge federal tax break. You could argue, especially if there are significant administrative costs, that some portion of that windfall that they're getting should cover those administrative costs. It also gets a little bit in, depending on how you design it, it gets into the fact that the unincorporated business tax is structured differently from the personal income tax. So if you're essentially having businesses pay through the unincorporated business tax to create that change. So there's some technical details we worked out.
So that district high-income lawyer would no longer be disadvantaged by his colleague across the hall who lives in Maryland and Virginia relative to this, in terms of being able to deduct his DC, I guess in effect, his DC taxes.
Right, are they in the same firm or are they in different firms in your example?
I mean, I think it's the same.
Doesn't really
but
matter, yeah. It's optional, so an interesting question that I haven't really figured out the answer to is that for that Maryland attorney, is there an advantage to them paying this pass-through entity tax and then claiming a credit against their Maryland taxes? That's actually a scenario where the district could also make money, as if people are paying the taxes to the district and then they get credit for that against their Maryland taxes. I think it's unclear to me.
What is the take-up rate with these salt? Like, it seems that it's super complicated thing. I get caught in the salt cap, but I would not, in Virginia you can do this. But I wouldn't even know how to start doing this as an individual homeowner.
Yeah,
It's significant. I think California, New York collected 22 billion from these taxes, PTEs. Now they're giant states, but like it's enough that we did the TPC, that we ran the numbers on the PTE tax went up and the income tax went down, but it's just because they're shifting. So the people who this applies to, I think, learn it real quick.
I would say one argument against it is that a lot of these people, in DC, we have a lot of people who are living in the suburbs and working in the district, and this is not really for them. This is for people who are living here and working here. So that's less, the California example, and that's why I think the district hasn't done this.
If you're a higher moderate income to higher income family in DC, let's say you're paying $100,000 to DC in taxes, this is significant.
Yeah, it's 7.
I mean, give somebody a break in this movie, right?
I mean, this is a lot better than a proposal to raise the sales tax. So,
Okay.
Glenn can do it.
Let's see, what should we do now? All right, so now we've got a few more, I think they're all, that should work. Fees and fines, number 2. So now we're circling back to the issue of clean hands. The current threshold,
What number is that?
FF2,
That's true.
so this is ending the practice of preventing people from getting occupational and business licenses. Currently, if they have more than $100 of government-related debt, for instance, back taxes, they cannot obtain occupational business licenses. So this includes, various various infractions with DCLP or Department of Buildings, as well as taxes. The proposal here is not to completely eliminate the clean hands. We heard speakers who said, well, look, it's not, folks who are wanting a barber's license or a bartender's license ought to be able to do that. That's how they're gonna earn the money in order to pay off their debt. The proposal here is not to completely eliminate the clean hands rule, but to increase the threshold from the current $100 to $5,000. $5,000 was chosen just because that is a threshold that the council has considered. Until now, I don't know what that's based on, but presumably it's scalable. And by one estimate, a pretty significant of the DC adult population would be prevented from getting a license under that $100 threshold. The $5,000 threshold would allow a lot more people to get licenses. Be similar to what the DC Council did around driver's licenses. And arguably, DC has other mechanisms to collect these kinds of fees. The arguments against the change, of course, is that this is a strong, and OTR spoke to us earlier this year and said this is a strong and effective and important tool, the Clean Hands Rule, to collect various debts that are owed. And the estimate from ORA, based on info from the OTR folks, is that this will reduce revenue by $10 million a year. In other words, people would pay less of their taxes if they are not required to pay those taxes in order to get an occupational or business license.
But occupation and business license issuance can't be the only stick that OTR has to compel compliance. So you're saying that one elimination of that one stick is a $7.2 million hit?
Mm-hmm.
Yeah, I want
That
to see
seems,
more
I don't know.
information. So what is our limit right now? 100 bucks? So let's say the typical thing is $300. That's 33,000 taxpayers. Let's say it's $1,000. That's 10,000 taxpayers. I mean, I'm just kind of curious how many people do get caught in the clean hands with an actual liability.
ORA says that about 2,000 entities or individuals were denied clean hands because they had OTR debt of less than $5,000.
Whether we increase the threshold or not, I mean, I would certainly support it, but there also has to be some workaround for when it's the government's fault that they have asked for funds that they're not entitled to. And therefore, and this is not on you, Greg, but I'm just, I used the example before that if you operate in 3 jurisdictions and you pay unemployment insurance to all 3, there is a reconciliation of unemployment insurance, an offset of what you paid in the others, which is a super laborious and painstakingly nauseating experience to try to reconcile this, right? Because you've got to know where David worked here, what days of the week, what applies, the whole thing. Huge burden there. It takes the Department of Employment Services, that was hampered by COVID, it takes them up to 2 years to process a year. It can take them 18 months a quarter, all right? And it's not uncommon for them to be years behind in the processing. I'm not trying to say anyone's not doing their job. I'm just saying it's just the reality. So if they can't do the reconciliation, what they're doing is they'll send you the bill, and the entire time they are working on it, you are getting administrative fines and penalties assigned to that. So it started out as 10,000, becomes 30,000 or 40,000. You see what I mean? Before it's reconciled, and then boom. You think, well, that's no big deal, because eventually they're going to reconcile it. Except if you're going for a business license. There's no business license if there's outstanding. If you're going to procure with the district government, your SOL, if you're trying to get your CBE certification, you can't do it. So it can stop a business in its tracks, even if it's not the business owner's fault. We just have to be mindful of these administrative things that catch people who want to do the right thing, who did the right thing. I don't know what the answer to that is, other than increasing the threshold, I think that should clear a lot of this out. Okay, that I support. It's not gonna help people that maybe, around this table. But then some acknowledgement that, and I know that OTR has been very flexible, but it's a matter of someone has to find OTR to get that flexibility. You see what I mean? A small corner shop isn't gonna understand they don't have your cell phone number, Glenn. So being sensitive to that is all I'm suggesting. There's gotta be a mechanism that could result in like a regulatory relief by giving people an opportunity to apply for pending a dispute, the current dispute resolution process. Does that make sense? What do you think?
I think we have pretty broad authority to deal with those issues. And we'd be happy to provide specific examples of how we execute that. I think we do have pretty broad authority to, address fees, certainly interest penalties and whatnot, when there's a legitimate dispute happening, and I want to use that term carefully, legitimate.
I know we do, but these are Department of Employment Services collected amounts.
Right,
So
I understand.
I'm going back to the corner store of confronting the OES, trying to figure them out, get that straight, and then realize they've got to get someone in your world and then start forgiving these things. It's just, it may be simple for someone who does it every day, but Glenn, it's just not simple for people who've never done it. And I don't want them losing their license, losing their procurement opportunity or their CBE. That's why I'm just suggesting maybe we memorialize or somehow highlight the fact that there is an out. Maybe we don't need to do anything legislatively. Maybe it's a matter of like that for our taxpayer ombudsman. That seems like a perfect rule for that. As we build them up, one place to call and say, Judas, I'm doing my best. I'm about to lose this. Can you help me? Maybe that's the solution. I'm just wanting to call out the issue.
Sure.
Well, the way this shows up for us is that, we have a workforce center that people walk in every day who seek help not only to get jobs, but want to start small businesses. We've partnered with nonprofits who can help people start small businesses. We get through the process, we have a clean hands issue, $100, can't get a license, can't move ahead. And this disproportionately impacts our residents east of the river, right? So I am absolutely for moving the needle on this because I see this, it's interesting because these are debilitating effects. So real quickly, if you could just have me opine on this a little bit. So we had barbershops right there at the Villages of Parkland, in that shopping center. And it's now moved. But we've had several of those barbers. We just did a huge back to school haircutting thing at the Arc, which was great. But I just had to plug that.
I went.
It was phenomenal. I think we cut 1,200 heads. It was terrific. We gave out like 1,000 bags. It was phenomenal. But my point is, many of those young people with that skill set come to us to help with the documentation pieces of getting the licenses. And $100 prevents them from becoming the entrepreneur they desire to be, right? And so we really got to figure this one out because I've seen it firsthand and talked to barbers firsthand where this has been a debilitating thing. And it disproportionately impacts our community. I mean, that's just the bottom line. Say again?
Yeah, this is where you're thinking of, well, I don't want to interrupt somebody else making a point tonight. Okay, so this is where, you need a broader comprehension definition of value.
Yeah.
So the future value you're losing of these entrepreneurs, getting on the tax rolls, employing more people, taking care of their families, how do you calculate that? Right? We need to figure that out.
Yeah.
That's a good point.
Yeah, totally agree.
Nick, you mentioned that there are 2,000 taxpayers that have $5,000 or less in tax liability.
They were denied.
And we're denied.
2,000 denied
Denied
from
from
OTR
finance.
and another 1,300 from DRV.
So that's the $10 million, 2,000 times 5,000. Maybe it's worth looking at what their average tax liability is, not the maximum that they can have. Does that make sense?
I mean, changing if we bring the threshold down, how much?
Right now it's $100. The average liability is probably less than that, right? not everybody who gets caught.
No, right now it's about, the number that were denied clean hands in the last year is 2,000, plus it's actually 2,000 for OTR debt, 1,300 for DOES. So 3,300 unless there's overlap.
Yeah.
So those are between 100 and 5,000.
Okay.
I don't know what the average would be.
So I have to say that my tax organization feels that this is an important tool to not allow people to miss their tax responsibilities. I'm sure there's dialogue about how to place this number, but 5,000 is something they feel that there's, that if you do the simple math, it's an average of $3,600. That's quite a tax liability just to ignore for taxpayers who are in arrears. We have a whole series of ways for people to pay that off. So I'm supportive of the commission moving forward with any recommendation, but I'm going to have to say that probably my organization will be pretty clear with what we think that this will do to tax compliance, and that won't be random. There'll be information that we have or other experiences that we'll bring to bear. So that's different than the occupational question. $100, yeah, that any reasonable person be concerned about that. It's $3,000, it's the $4,000 tax liability. And so perhaps there's different ways to scale this, but we will have another bite at this apple. Just want to be clear. And it's not disagreeing with the comments made. It's just, this is an important tool for us on the tax side.
Is there a number that you think your organization could live with?
I can bring something to bear along those lines.
It might be good to find out why, because I think this was McDuffie's bill, why they set it at 5,000. I'm sure there was some thinking behind it. But I also think, the point of sort of like, what's the future value of letting people get their licenses and being able to pursue a business? It's like, I wonder how much those estimates factor in the fact that people might actually have more income to pay their debts if they are able to open a business or keep their business going and generate that income. I think that I'm assuming that's not factored into the $10 million.
That's a reasonable assumption.
So, I guess my point is I'm not sure that estimate is accurate in terms of like what you could expect people to pay. But maybe there's other assumptions in there that I'm not clear on. But I think I fully support this proposal. I just think that there's like 125 occupations for which you need a license. CORE found that when they ran their analysis of the bill that was before council, found that this heavily disproportionately burdens Black residents here in DC. Probably the same folks that are feeling all kinds of economic pressures right now. And so to sort of say, oh, and also, you're not able to pursue this form of income, seems like we're undercutting ourselves.
Can we just separate the professional licenses from the tax liability issue? And just say, if you have a tax liability, you will still be able to get your professional license.
My question earlier, don't you have other sticks to compel payment of taxes? I mean, is this the only one? I mean, I think the government in general.
Yeah, we have other means, and depending on the type of tax liability as well. So, all the way up to property sales if it's a property tax.
So it doesn't necessarily mean that you're foregoing any and all compulsory measures if you just carve this out.
Right. So in the context of all our tools, our staff still feels that this is a really important one to have. And
Sure, because it goes for the,
It's the easiest way to.
you're preventing somebody from working.
Yeah, that's not good.
I mean, it's a pretty harsh penalty.
I guess the only way to think about it is it's costing us $10 million according to this estimate. If you take out the license fees, I don't know what, let's say it's $8 million of lost revenue. Again, this is nothing small, but is in a bigger scheme of things, it's not really that big either. So it's, for enforcement purposes, maybe it's important, but it's important because it catches these small things that you wouldn't want to invest any audit time and whatnot in. I think the more important question to me would be, if we do let people increase their tax liability from $100 to $5,000 right now, is that a bigger problem to solve, and does it actually lead to harsher actions by OTR than we would want to avoid? That's why I'm kind of thinking about separating the license piece from, like, you still get your business license, you still get your occupation license, but the action triggers something that allows OTR to enforce the tax collection. I don't know.
Isn't that already the case? I mean, wouldn't that already?
No, that's not the case. You don't get your license. That's why you.
No, yes, but like, you know about debt, outstanding tax debt, regardless of clean hands, right? Like, that's not the thing that triggers your department to go try and get people to pay their taxes.
Right, we know, well, yes. Because if it's an income tax, voluntary tax response, report, if we know if you haven't filed and you have in the past, or if you filed, you've identified a liability but you didn't pay, we know that precisely.
Right. So you don't need the clean hands process to be able to go.
There's maybe a nuance here I don't understand, but I don't disagree with you.
Well, I think, Yashim, you're saying, can you separate the two? But I think they already kind of are, I guess is my point, though.
It's just leverage, that's all. They're not connected, they're not twins.
Right.
They're just leverage. You use it to get people to pay their taxes. Yeah, that's it.
Yeah.
All right, so this was helpful. I'm going to propose that we've got 4 more on the docket, but given the hour, I want to propose that we do one more, what I think is a fairly straightforward one, the automatic conformity with. I'm thinking it's last words, yeah, and save the other ones for another day. And I'm going to suggest that we do the miscellaneous number 3, automatic conformity with federal tax changes.
Yeah, well, it's certainly
What
more.
numbers are again?
Miscellaneous 3.
Miscellaneous 3.
So, to jump around a bit, every state with an income tax conforms with the federal government to a degree. This goes from everything from, say, the definition of an eligible child on your return to how you're calculating capital gain income. The reason states do this is it's very advantageous, because it means Treasury and IRS is doing a bunch of work that Glenn and his team don't have to do because they get to do it. And then we just piggyback on them, do some different rates, and we're all good. There's 2 ways to do this. The way the district does it is called rolling conformity. It means automatic. It means that if Congress changes a law that's in the DC's code automatically changes. Roughly half the states do it that way. You also can do what's called static conformity. The other half do it this way. That means you have to approve every single thing Congress does before it gets into your code. And so this is a very relatable trade-off. Automatic, simple. It's understood. When Congress passes something, we know it's in ours, we can get to work on it, people who do business can do it. But it also means you're possibly accepting some stuff that you don't like. When Congress makes big changes like they did in 2017, and as they might do again in anticipation of TCJA expiring, all that will get thrown into our own little policy blender and we'll have to react to it because it becomes law automatically. The other side of that coin, though, is that control comes responsibility. It means you must be on top of everything Congress is doing, because if you don't act on it, it won't change, and now your taxpayers will be faced with 2 different set of rules, and your tax administration will be set with 2 different set of rules. And so the DC Council will have to move a little quicker on all these things. So it's just kind of how you think it is better, especially I would say that we didn't have this conversation 10 years ago because Congress never changed laws. We're actually on a place the way they keep doing these little 10-year windows every time they pass a tax bill, that they're constantly churning up the tax code, and there's a high chance for volatility for the federal changes and for them affecting DC. So it's, what do you think is the best strategy to either have to go through and react, or to have to react to everything before it goes through?
But don't you have to do that sort of anyway? Like if they change it and it automatically occurs, doesn't OTR have to know that it changed and prepare for what the change is and accept the change and know what to do with it when it comes in, or no?
I think a good example is what happened with the last tax revision commission. There was a lot of effort put into building a tax regime that, you know, using the standard, personal exemptions, right? And the day that our package became fully applicable in DC was also the day of its undoing. It's the same day that when the Trump tax cuts became effective. So what that meant is this policy choice that the city made, using as the certain definition of income, flew out the window, and the only option to bring it back is for the DC Council and the mayor to introduce enact a legislation that says, okay, we're gonna ignore what the feds are doing, we're gonna use the old system. But therein lies the problem, because the more you deviate from income definitions that the Fed has, the more of the compliance burden shifts from the feds onto OTR.
Or our taxpayers as well.
That's right.
Yeah,
Because they have to follow.
be really clear, it's the taxpayers probably more than us. I mean, we have things to do, but now think of being home at, on April 14th, trying to figure out two different definitions of income or a particular credit. That's the motivation, is to protect taxpayers, and I'm just speaking personally.
But again, on an economic cost benefit analysis, what's the cost to us economically by some calculus of rolling conformity we have right now? I mean, we got anecdotes of this or that happened, but just economically, where we roll with the flow, so to speak, what's the economic impact?
One impact is we get stuck sometimes with provisions of federal law that they may be good for the country as a whole. They may not be particularly beneficial for the district.
But number, do we have a number? I mean, we're dealing with numbers.
Because it all depends on what the Congress does, and we can't predict, so yes, and yes, the personal exemption, we passed changes, which was a tax cut for everyone, but basically we're gonna give a little bit more to families. When Congress made the change with the standard deduction going up, and the personal exemption going down, DC's actual tax cut that I implemented actually went to childless a little bit more. Now, everyone worked out okay, but because that wasn't a huge change, the DC Council just didn't do anything and let it take effect. Or you think of the estate tax, where we tried to conform to the federal level, we're gonna pass a tax that shows we're business friendly, we're open to wealth, because we thought that was gonna be at 5 million. But then Trump took it up to 10, 20 million. And so then DC had to come in and say, no, we don't want that as a part of our thing. Capital gains is interesting, where there were proposals to cut the capital gain base in half in TCJA. That didn't happen, but if it had been part of the final bill, all of a sudden the district would have lost half its capital gain tax base as soon as the TCJA was, and of course, they passed it on December 26th. And so there's a constant scramble to keep up with them.
So won't that be the case regardless? What if they pass something that increases our revenue, but we don't have rolling? Now we have to introduce
It's
a bill.
just about timing. So it doesn't mean we can't conform, right? There's
Right.
nothing
You can
about
always
this that
choose.
says
Who
you can't.
leads,
It
right?
just
Yes.
means
Who
who
leads.
leads.
Yeah.
Do we wait and see what happens and then decide what we want to conform to, or do we just go ahead with it? I mean, there might have been a time when I would have said we should just be rolling with it. But given the kinds of changes we saw with the last big tax package, I mean, there's a lot of
Maybe
crazy
it's
stuff in there. There was good stuff too. I mean, we had expansion of the EITC and some other things that we automatically.
We don't have a
So it goes
legislature, I'm
lots of
sorry
ways.
for interrupting, we don't have a legislature that can do this.
That's fine.
Okay, I think we are all living in a little bit of a fantasy land,
We
may I?
do it though.
But we don't.
We just do
All
it on
right,
the
can
other
I-
end.
No, if I might. You have 13 members, 13 elected officials, 7 people in the city can make murder legal. Only place in the world, right? It's true. In New Hampshire, a state that's smaller than ours, you have in the state legislature that's nearly, 600 people. You have got town councils, school boards, county councils, et cetera. You have 1,000 people in the state of New Hampshire that do what 13 people have to do here. Same is true in Vermont. So you have one chairperson. The way the council works is the chairperson of the relevant committee has to keep on top of everything because it's like a college of cardinals. Depending on who that is on any given day, we might get lucky, we might not, but the fail-safe can't be one person. If something bad happens, I'd rather folks come to the Wilson Building, get that person's attention and say something's got to change here, rather than make that person responsible for reading the tax code and implementing it affirmatively and making this decision, yes or no on everything. I'll give you an example, Mayor, of where if we had had decoupling, it would have hurt the city's economy. The opportunity zones. Had we decoupled the federal from the local and not had a local benefit from the opportunity zones, stuff that's happening on Reservation 13 wouldn't happen. Because companies that were looking to make these OZ investments weren't going to places that decoupled, period. And let's assume the council didn't like it, they could have changed it. But it's the mere waiting to get the attention of that one person and that of her or his colleagues and getting it through the council and scoring it that we miss our opportunity to be a part of, enjoying the taxes we spend to the federal government.
But we did decouple from some of the capital gains provisions in the OZ.
So the current
law.
system
So
works.
I'm saying, but that's the point, is we do make those decisions affirmatively or, against those policy changes. It's just about timing.
Again, I just,
Well, I think you're in agreement, though. We could have rolling with spot objections and
yes,
decisions.
I agree.
That's
I
what we
support
do
that.
now.
I support that.
We could do static if we think that there's gonna be crazy changes at the federal level that we're not, we
Maybe
don't
we're
really wanna
just-
deal with.
Maybe we're just disagreeing on nomenclature, because to me, static is a permanent state. Whereas what you're saying is we can, on an exception basis, disagree and go our own way. I think everybody agrees with that.
States that have static conformity do periodic, like almost every year, they might have a bill that updates their code to the federal code, but it gives them the ability
I agree.
to say, to
I
step
can't
back.
see us, that's just a lot of work for DC.
I agree with that.
To move that bill.
You're introducing political risk. So, in some cases where it shouldn't be.
I don't think it's more.
Yeah.
There is
It
political risk.
sounds like
Yeah, I
but
think it's the same.
But it sounds like a capacity to perform issue,
Well,
right? I mean, that's what I'm hearing you say.
I think it's a capacity to perform issue, knowing how limited the attention and staff are of the members to keep track on every single thing that happens, to affirmatively say yes, no, yes, no. I think we've got an active group of people, many of us up here know the government, when something goes wrong, we go down there and we tell them, and we go from there.
can I say one thing at the end?
Yeah.
About a different topic. About a different topic. All right, so I think it'd be helpful, maybe as we get towards like the penultimate meeting, to have, we have to begin to think about the narrative of our report besides what the dollar figure is. So we have to be able to have a list of like, tax simplification, aid to small business, even if we're not providing monetary relief. I think we've got to be able to think of what would the press release of our report say cumulatively about all these actions that we're doing, because I think we're starting a narrative that I'm already beginning to kind of see here. I think it'd be good to just track it. And so when we're looking at dollar figures, our big impact may not necessarily be monetary relief, but it may be we reduce the number of forms to be filed, or we've eliminated certain categories. Like, there are several different ways, but we should just be keeping track of it.
Yeah, I like that. It's a good thought.
All right, thank you. Heavy stuff today. Thanks, everybody. See you next Tuesday.
Next Tuesday.
Next.